And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Tuesday edition. It's February the 25th of 2025. We've got a lot of twos and fives all in the day today. So, but yeah, so, we're kind of wrapping up this final week of the month. Again, we just had options expiration last Friday, and so this is kind of the last stretch for this month. Still trying to figure out if my milk is actually going to expire on February the 30th as it's currently dated. So we're putting it to the test. We'll see about this soon. But anyway, a few things going on yesterday. I mentioned yesterday that the Chicago Fed National Activity Index was coming out. Now, this is a very broad measure of the economy. It's about 85 indicators of both manufacturing and service data, hard and soft, very, very broad. And this is not just for, even though it's called the Chicago Fed National Activity Index, it's not just for the Chicago area. This is for the nationwide. So this is 85 indicators nationwide. And it actually printed a negative print yesterday of negative 0.13. Now, the important part about that is that weakened considerably over the last couple of months, and we've seen that same kind of data catching up through other areas of the market as well. We saw GDP come in weaker than expected. We saw retail sales weaker than expected. So, we've talked about that there's been this kind of impending weakness kind of showing up in the economy, and it's been kind of this slow roll, this lag effect of all that money that was out there kind of working its way through the economy, and the economy was going to slow down. Well, we're now starting to see that a little bit more in the data. So what now? It doesn't, this doesn't mean an impending recession by any stretch of the imagination, but it does suggest that the economy is growing a bit weaker than what a lot of analysts are expecting. And one thing we'll go through this morning is I have an article on the website this morning about Wall Street estimates for 2026. They have absolutely gone parabolic. So here we're in the situation where the economy is slowing down, and we have analysts very optimistic about earnings growth. But earnings have to come from economic activity. That's the consumer. And very interesting this morning, there's a chart. I posted this out on Twitter this morning. But if you take a look at what's called excess savings, and this is a new thing that's been thrown around as of late, right? So this is just the savings that people have right now, supposedly, above the level they had pre-pandemic. So we sent all these people extra money. They didn't have to pay mortgages, they have to pay student loan debt, all this type of stuff. So supposedly, they have all this extra money to save, right? Well, if you actually dig into that, the top 10% of income earners have about $1 trillion of excess savings from post-pandemic. The bottom 90% of savers, not so much. They're basically about back where they were in just pre-pandemic. So the important part about that is that yes, if you're in the top 10% of income earners, this has been a great market. It's been a great economy post-pandemic. People are making a lot of money. So yeah, you probably have, if you've got money invested, you're probably doing very well. I've talked before about, it just seems like there's all this money that just keeps kind of coming into the markets on a regular basis. And, it shows up if you're in the top 10% of income earners that own 90% of the stock market. Yeah, you're doing really well. Now, the bottom 90%, which don't own much of the stock market and are pretty much tied into their whole net worth is really tied around their wealth, they don't have a lot of excess savings. Now, the important part about that, though, is that feeds into economic growth. And we're starting to see that bottom 90% of people beginning to struggle to make ends meet and to continue to consume. Access to credit is becoming more difficult. That's weighing on consumption trends, and that's showing up in some of this economic data that we've seen as of late. Now, is this pretending to a recession? No, not yet. We don't have that kind of economic data, but we are seeing weaker economic data, and as we'll go through this morning, that's important relating to the markets and relating to valuations in the economy in particular because of that impact of economic activity on earnings. But before we get there, here's what you need to know before the bell. So yesterday morning, we talked about the fact that the market was had a correction on Friday. Part of that was due to the virus news. Most of that was due to options expiration on Friday. Had come down to the 50-day moving average. Now, yesterday I said, be careful. I said, it's very likely the market's going to open up positive and it will probably fail. And that's exactly what happened. The markets did open up. We tried to challenge the 20-day moving average and almost immediately failed, went negative, and then clawed its way back towards the 50-day moving average during the day. In fact, hung out there at the 50-day moving average pretty much all afternoon until the last 15 minutes. Now, this is important because on Friday and yesterday, we saw all the selling occur really in the markets in the last 15 to 30 minutes of the market. That's institutions at work. Institutions tend to transact right at the end of the day. And in both Friday's action as well as yesterday's action, in the last 15 minutes, the market just kind of dumped in both conditions. So again, we're seeing this downward pressure in the markets. We talked about yesterday that we triggered this MACD sell signal. Money flows have now started to turn negative. So we're not negative yet. The money flows overall are positive, but they're becoming negatively trending. So we're seeing money coming out of the markets. That's corresponding to the sell-off in the markets that we've got going on right now. What is happening here? This suggests that we're likely going to be in a corrective phase here for at least a bit. Maybe the next week, maybe next 2 weeks. We're going to try to challenge in the next day or so. I would imagine before the end of the week, we'll probably try to challenge this 100-day moving average. Now, again, there's a couple of data points that are coming out this week that could give the markets room to rally. We've got on Thursday, we've got NVIDIA reporting earnings, and then on Friday we've got the PCE report. Now, if NVIDIA reports, really stellar earnings and really great outlook and kind of resolve some of this concern over AI expenditures that happened with Microsoft yesterday and Friday, then we could probably see this market try to rally here a bit. If PCE comes in cooler than expected, saying that the Fed has got room to potentially cut rates, that's going to cause the markets to rally. So there are some catalysts to provide for a rally towards the end of the week. If that occurs, and we will get a little bounce in the markets, no doubt about that, either tomorrow or the next day, we'll get a little bounce here. We've had 2 strong days of selling. We get a little bit of a bounce. Use that bounce to reduce some risk, rebalance your portfolio, raise a little bit of cash as needed to help you be comfortable. But we are starting to see that kind of negative pressure, negative sentiment in the markets, and that's going to probably last here again for a couple of weeks. 2-3 weeks as we kind of work through this process, get markets back to more oversold conditions. We're getting there, but it's going to take a little bit of time to work through this. And as we talked about before, the market's really just been stuck in this very broad consolidation range now for about 3 months. I mean, it's been kind of frustrating. Markets really haven't gone anywhere. We see pockets of selling and then it kind of rotates through the markets. It's, technology one week and then it's discretionary another week and then it's staples the week after. So markets have just been kind of really gyrating through this rotation in the markets. Oversold positions, getting overbought, getting back to oversold. But markets really not doing much here as of late. And again, that's just part of this corrective consolidated process we're in. But again, there's some risk here of more downside over the next couple of weeks. So again, just use rallies, rebalance your portfolio as needed, take some risk off the table, hedge if you need to hedge, but just be aware of your exposure to the markets as we kind of work through this process. That's what you need to know before the bell this morning. When we come back, I'll pick up with John Penn. We'll talk a little bit about earnings, a few other topics to get to as well, so don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WE GP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So there's a lot of stuff going on right now, and Washington, of course, and with what's happening. It's interesting. Brent will remember this conversation, and on the show from time to time, I get asked, well, we'll talk about the debt or the deficit or whatever, and I'll get asked the question, well, if you were president, what would you do? Right? That's always kind of the question that gets asked, and I've said numerous times. I said the first thing I would do is I would tell the American people that in order to fix Social Security and do these other things, that it's going to cause some pain, right? We just can't fix these issues without causing some pain to the economy. But before I asked Americans to suffer some pain, that I would clean up Washington first. And so we're seeing that actually going on right now. And it's not going to be pain-free. There's going to be consequences from laying off federal workers that they're receiving a paycheck. They take that money, they spend it into the economy. Now, will that help longer term if we can clean up the spending in Washington? Interesting graphic out yesterday I posted on Twitter that it showed the federal expenditures and federal revenue of the government. And it broke it down by mandatory and discretionary spending on the expenditure side and interest on the debt. So if you take the mandatory expenditures, Social Security, Medicare, Medicaid, et cetera, that turns out to be about $4.2 trillion. Interest on the debt is right at $1 trillion. So 4.2 plus 1, you're at $5.2 trillion. The revenue collected by government last year was about $4.8 trillion. So all the revenue we collected was spent on Social Security and on interest on the debt. Everything else, all the discretionary spending for Department of Education, all these other things, that all came out of debt. So in order to shore up the deficit, right, you've got to get your revenue and spending a lot. And that's what's kind of happening in Washington right now. They're working on that. But it's not going to be pain-free because you're extracting money from the economy that's getting spent. And we're going to potentially see that show up in things like retail sales, slower economic growth. Why am I telling you all this? Because analysts right now are extremely exuberant about earnings going into 2026. S&P just released their earnings going out, their estimates for 2026, and Brent will bring this chart up for you. But this is just kind of a brief analysis of where we are. So the black line is where we are right now at quarter four, which the kind of that upper there's if you're driving right now, don't try to look at the graph, but on this graph is a picture of earnings going back to 1936. And there's a line at the top of this that goes from peak to peak of earnings growth. That is 6% earnings growth on a peak-to-peak basis. So earnings tend to grow at the rate of the economy. If you track back the economy back to 1936, the economy grows at about 6%. The estimates right now for 2026 and really 2025 are well above that long-term growth trend that's peak 6.6% growth. The long-term trend of growth, the exponential growth trend of earnings, is around $195 a share. So you're talking right now, analysts are expecting in 2026 earnings to come in at nearly $289 a share. And the exponential growth trend going back to 1936 is 195. So just the exuberance of the markets is just as quite interesting, and particularly we're going to look at this a little bit differently here. But if we and again, we can kind of prove out this thesis, right, that earnings grow at the rate of the economy. So if we take earnings and economic growth going back to 1947 on an annual basis, what you find is there's a very high correlation, as you would expect, right? This isn't rocket science, ladies and gentlemen. This is a function of where do earnings come from? Well, it's what we do in the economy. It's what John goes to eat dinner, Brent goes to buy a pair of pants, whatever it is. That's activity in the economy. John goes to buy his dubs for working out, so he goes to Lululemon. Gets his Lululemon out, his little workout gets his little workout outfit on. But I'm just messing with you, John. But that's where Lululemon's earnings come from, right? So, if you're buying, then of course that's that revenue, and then after they pay their expenses, that's earnings. So there's a correlation that should not be surprising between economic growth and earnings. But how is it that if that's the case, that we have Wall Street so far deviated above kind of what the market would generate in reality in terms of earnings, right? And that's a function that, analysts right now are trying to justify valuations. So over the last couple of years, earnings have not grown at the rate that earnings or that analysts expected earnings to grow. And because it didn't, and the price of the market went up, you had valuation expansion. So valuations right now are very elevated above economic growth. In fact, if we take, and again, this is kind of the interesting thing, valuations track economic activity. And most people don't think about this, but again, if markets are tied to economic activity for earnings, valuations are going to track the growth rate of the economy over time. Yes, there's times it can get deviated from that, like now. Economic growth is slowing and valuations are rising, and that's because earnings aren't keeping up with the price of the market. So we're going through a phase right now called valuation expansion. In other words, we're just increasing the valuation of the market without the underlying growth of the economy. So analysts are very hopeful that the economy is going to play catch up here just any moment now. We're going to have this big explosion in economic growth. In fact, right now, economists are ratcheting up their economic growth rates for 2025. They're saying that consumers are going to get stronger this year, not weaker. There's no real evidence of that right now, but that's what they're hopeful for. And why are they hoping for that? Well, if economic growth rates pick up, then that means earnings growth will pick up, and then I can justify valuations. Here's a chart of the annual rate of change of the S&P 500 earnings versus the year-over-year change in price. And what you'll notice is that over the last 2 years, we've had this massive surge in the year-over-year rate of change in the price of the market, but earnings haven't kept up with that. Normally, they're much more correlated. But the price of the market has grown substantially over what earnings are actually being generated. So in order to justify market expectations, in other words, to justify current valuations, I've got to ramp up the earnings to justify the current valuations. rather than saying, hey, maybe markets are just overvalued and we probably need to go through a corrective phase. No, what I'll just do is I'll just say, well, earnings are going to grow by leaps and bounds over the next year, and that's going to really, that'll justify current valuations in the market. So yeah, even if the market slows down a little bit, we're still going to grow at a pretty good, healthy clip because earnings are going to justify that. You've got to be really careful with that because there's no historical evidence that suggests that that actually occurs. In fact, what actually tends to happen is that these overvaluations tend to correct themselves back to the reality of what's happening in the economy and with earnings. And, yes, right now we have some substantial drivers in the market like buybacks. We'll have $1 trillion worth of buybacks this year, largest on record. And that certainly helps support the price of the market. But again, at the end of the day, if companies aren't generating the earnings growth, then valuations are going to get repriced. And that's the setup for a bit bigger correction in the markets at some point down the road. Again, doesn't mean today, doesn't mean tomorrow, doesn't mean next week. But again, I think as investors, you have to pay attention to what analysts are currently expecting today, because if you're buying the market today based on $290 a share in 2026, you're probably way overpaying for asset prices, because it's very unlikely that the markets are going to be able to generate that type of earnings growth if the economy continues to run at about a 2% growth rate, which is kind of where we're headed to right now. So we'll see what happens. But again, that article's on the website. Again, if you're driving this morning, it's just go to the website, realinvestmentadvice.com, or go to our Substack page at Lance Roberts. And the article's posted there with all, there's more charts and graphs. I mean, I go through a pretty deep dive through buybacks and earnings and everything else, so you can kind of just break it down. But again, it's all on the website, realinvestmentadvice.com. All right. Having said that, good morning, John. How are you?
Good morning. Good.
Any thoughts?
Well, so the chat is alive and
well,
very vigorous this morning.
Of course,
and we appreciate
usually.
it. But so Michael, you bring up a really good point in there about the Buffett indicator, the Schiller CAPE, the Schiller PE ratio, all being overvalued. You look at the Schiller PE, and it's at, I think, at the third highest level that it's ever been. I think the highest that the Schiller PE ratio was in the late 1999, getting into 2000. And the Schiller PE, it's a great rate. It's a great indicator, but it's not saying that there might be a market crash or like a big pullback coming anytime soon. It's just letting you know that yes, compared to historical standard, from a historical standpoint, markets are elevated. Yeah. Things are pricey. So what does that mean for future returns, right? And will we have returns like we've seen in 2024, 2023? What sort of return expectation can we reasonably expect moving forward?
Right. And that's a great point about the CAPE ratio or valuations in general. Valuations are a terrible market timing indicator. Yeah. They tell you everything you need to know about long-term returns. Right. And in fact, I have an article coming out on Friday that I'll tell you about right after the break, because it goes specifically to the Schiller CAPE ratio. Yep. Because there's been lots of articles out that say the Schiller CAPE is complete BS. I'll tell you why it's not in just a second. Go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal level of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So today's earnings announcements are making me hungry. We have Cheesecake Factory, followed by Wingstop and Toast. I've got a craving for toast and wings right now, and
Toast
some cheesecake.
and wings.
Toast, wings, and cheesecake.
The Real Investment Show podcast.
What diet are you on right now?
Don't eat anything and work out like a fiend. So
Yeah, how's that working out?
It's working out great.
Oh, you
I've
sure?
lost 4 more pounds, so I'm down.
That's it?
At realinvestmentadvice.com.
I didn't have that much to lose to start with.
I don't know.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just for the break, welcome back to the show. Just for the break, John mentioned about Schiller's CAPE Ratio and valuations, and there was a comment in the chat about this. A couple of things to understand about valuations that are very important. If you look at valuations and go, oh my gosh, valuations are so high, right? And that's making you pause about investing in the markets. You're using valuations wrong. That's not what valuations are for. In the short term, within the next 12 months, next 24 months, next 3 years, next 5 years, all valuations tell you in that time frame is what sentiment is doing in the markets. In other words, valuations are high right now, yes, because investors are willing to overpay for earnings. That's it. That's all valuations tell you. It's a sentiment indicator of the markets. In fact, if you overlay consumer sentiment with valuations, they have a very high correlation. And that shouldn't be real surprising, right? If consumers are confident, valuations go up. If consumers and investors are not confident, valuations go down. Schiller's CAPE ratio gets a lot of bashing because it's like, well, the Schiller CAPE ratio, it's been high for a long time and the market's never crashed. Well, you kind of forgot about 2000 and 2008. But other than that, it hasn't crashed in the last 15 years, other than 35% in 2020 or 20% in 2018. It hasn't crashed in any of those periods because valuations were high, because it's not a crash indicator. What it tells you is what your forward returns will be over the next decade. And so right now, where valuations are, it tells you that you're return from the market is going to be probably around 0 to 3% over the next decade. Now, that doesn't mean 0 to 3% every single year. It means that you'll be up 10 one year, up 15 one year, down 20 one year, up 10 one year, up 15 one year, down 20 one year. At the end of the 10-year period, you look back, average all those returns up, and you go, oh, I made 3%. But it doesn't mean every year. So valuations are a terrible market timing indicator because it doesn't tell you anything about what the market's going to do near term. That's all about sentiment. However, I've created a version of CAPE that I'm writing about on Friday called the CAPE 5. The CAPE 5 is a 5-year version of Schiller's CAPE ratio and is much more tied to the market dynamics. It's a better leading indicator of where markets are because it ties it back to sentiment in a 5-year period. And so if you begin to see changes in that CAPE 5 ratio, it tells you where the market's headed or will be heading. So again, I'll have that article out on Friday for you, just as a different measure to look at. But again, just valuations are a great tool. But this brings us up to a conversation, or actually kind of brings us back to a conversation John and I had last week about diversifying the portfolio, looking for assets that are non-corollary to the markets. And particularly today, because when you start looking, as we talked about last week, you take a look at Bitcoin, gold, emerging markets, international markets. The correlation to the stock market is all one. They're all very highly correlated right now. So trying to find assets that are non-correlated is important to your portfolio because it gives you that buffer, that security against volatility. So if markets do start to decline, you have other assets that are not declining in tandem with the markets. And it was interesting because we talked a little bit about private equity last week on the show, and John had sent me this article about Tiger 21, which is a very famous. If you don't know who Tiger 21 is, Tiger 21 is a very, very famous investor group that was started by Tiger Woods. No, I'm just joking.
That would be very convenient with the name, by the way.
That would be very convenient. But no, Tiger 21 has been around forever, and it's a group of basically high net worth members, right? So all these people, you have to have at least $25 million of investable assets. They all get together, they share ideas, it's like a big investor club. And they all get together and they share ideas and outlooks and their connections and everything else. And so this is how people with a lot of money make a lot more money because they're networking with each other. They're like, oh, you've got this infrastructure deal. Oh, I'll invest in that. And then you invest in this deal over here. And they all go make a bunch of money together. But it's interesting when you look at, and again, we talked about before, when you take a look at a high net worth investor, and I kind of threw out some percentages last week. If you actually, this is, you can't really see it well, but this is, I'm going to read it to you, but this is a pie chart of how Tiger 21 members are allocated in their portfolios. 28% is real estate. That's also including their primary residence. So it's their primary residence, it's their second primary residence, it's their third primary resident, and it's invested real estate that they're in. Cash equivalents make up about 10% of their portfolio. Cash and cash equivalences. So they've always got liquidity on hand. And this is something that a lot of investors make the mistake about. It's like, oh, I've got to be all in the market all the time. And you don't have any cash or liquidity for opportunities when they show up. So they always keep about 10% of their money in cash for opportunities. So it's like somebody comes along and said, hey, I got this really great opportunity. I've got cash for it. I don't have to go sell other assets. I've got cash. Fixed income is making up about 10% of their portfolio. Commodities. Now, what would you expect high net worth investors have in commodities? This includes gold, copper, all that type of stuff. How much do you think they have?
I thought this number would be higher, actually. Yeah. I was surprised.
Yeah, 1%. Because it has no long-term fundamentals. Hedge funds make up about 2% of their portfolio. I thought that number would be higher too, right? Mm-hmm. Public equities make up about 23% of their portfolio. Private equities, 28% of their portfolio. It's a pretty big chunk because you have lower volatility, non-correlation to the stock market, higher returns. And you don't have this kind of public exposure to the markets. But so again, you take a look at their portfolio, you strip out everything outside of cash, which is 10%. You've got basically 80% of the portfolio is 90% of the portfolio is cash, real estate, private equity, and public equities. That's it. And fixed income. So it doesn't, it's not difficult, right? But when you take a look at their breakdown, they have a lot of non-correlation built between the real estate and the private equity and the public equities. There's lots of non-correlation between those assets, so it smooths out volatility over time. Anyway, I just thought y'all would find that interesting because these are people with $25 million or more. A lot of these guys have hundreds of millions of dollars that are in this group. So I just thought you'd find that kind of interesting.
Yeah, and I think a question that we get a lot of, if folks are, so I'll back up a little bit. I think folks are there looking for areas where they can invest where those assets are not directly correlated to the publicly traded markets, and I think that was the appeal of, and that's still the appeal of. Look at Bitcoin as an example, where folks are diversifying, or maybe they add a little bit of money to their portfolio in Bitcoin or gold or commodities, whatever it might be, because they're searching for an additional asset class, something that can be an additional diversifier than just holding stocks and bonds to some degree, right? But then over time, as of late, you can see that a lot of these different asset classes, stocks, well, like Friday, when markets pulled back by roughly 1.7%, bonds are up that day. Yep. So as of late, bonds are actually providing a pretty good hedge in the portfolio, right? But investors are still looking for other areas where they can find investment opportunities that aren't directly correlated to the publicly traded markets. And a question that I get a lot is, John, if I'm going to explore investing in private equity, or a broader term for that is the alternative investment space, is there a kind of rule of thumb for how much I should allocate there? Like what percentage of my portfolio should be allocated? If private equity makes sense for me, is there a certain allocation percentage? Is there a rule of thumb there, right? And so when you look at this report, I thought this report from Tiger 21 was very timely. So you're looking at these high net worth individuals. Of course, everybody's situation is different. They've allocated 28% to the private equity space. Now, that doesn't mean that you need to go out there and put 28% of your money in private equity. It may not even be appropriate for you, or maybe it's a 3% allocation, maybe it's a 5% allocation. It all depends on your own unique situation. And to Lance's point, sometimes with any investment, whether if it's publicly traded stocks, if it's cryptocurrency, if it's gold, if it's private equity, there's a tendency to want to over allocate there. And then you need to make sure you've got liquidity around these investments, especially in the private equity space, because typically these investments have a lockup period of 3 to 5, 7 years or more.
They also have calls.
Yes.
Where they have capital calls. So you've got to have liquidity available. So when you get the capital call, you can meet your capital call. Otherwise, you get liquidated out of your position.
That's right.
So at a discount. So certainly don't want to have that happen. But no, it's a, what's important to understand about this. And when you look at your own personal portfolio, it is looking at the volatility you're taking, the volatility risk you're taking in your portfolio. Again, if every asset class is correlated, and we talked about this previously. If you own, you look at your portfolio. I've got stocks, I've got bonds, I've got gold, I've got Bitcoin, I've got emerging markets, international markets. So I'm diversified. You're not, because they're all correlated. So in other words, they're all going up together, which means that when the market does break, they're all going to go down together, and some will go down a whole lot more, like Bitcoin will go down a whole lot more than the market. So all of a sudden, your what you think is diversified is all highly correlated, and your decline in the market is greater than what you would expect. And so this is why it's important, is that you own assets that are truly non-correlated. So yeah, when markets are going up, 5 or 10%, you may have another asset that's not going much at all. But if markets are declining, that asset tends to outperform. And so this is why it's very, very important to look at your portfolio structure and not worry about what the market's doing, but worry about what your volatility is doing in your portfolio relative to the market. And are you able to withstand those drawdowns without going into panic mode and making even worse decisions? All right, quick break. We'll come back, get ready to wrap up the show with John Penn. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. One thing, just a real quick little side note. We're just talking about real estate in general, and again, when you kind of look at high net worth investors, they have about 20% of their net worth tied up in real estate, and these are real estate investment projects and primary real estate, secondary real estate, what do you call a thirdly real estate? So tertiary real estate. Thank you. That's the word I'm looking for. So that's where they have all the real estate. One of the mistakes that I see made a lot, and there's kind of programs out there that on the radio and other areas that promote this as well, is like, oh, use your IRA for real estate. No. Don't put gold in an IRA. Don't put real estate in an IRA. Don't put any asset inside of an IRA that either that you can use for a capital tax loss at some point or has tax advantages to them. Real estate is one of those. Never put a piece of real estate inside an IRA. But Lance, if I put it in an IRA and it goes up in value, then I have tax-free gains. Okay, no. You may get that, right? If I buy it for $100,000 and I sell it for $200,000 and it's inside my IRA, I can tax defer that capital gain, but that's 20%.
Yeah, it's
tax
deferred until you need to take your required minimum distribution.
Right.
By the time you take your required minimum distribution, you need to make sure you have liquidity in your IRA, so you're going to have to sell that real estate, right?
Well, and not only that, though, you also lose all of the value of owning real estate, which is the depreciation, the expenses that go into real estate that are tax deductible. All those things, when you put that piece of real estate inside an IRA, you lose all the tax benefits of owning a piece of real estate. The reason that high net worth investors like real estate is because I buy a piece of real estate, I put it inside of an LLC, right? And so now that piece of real estate is inside of a limited liability corporation. And now I run that as a business, which gives me all of the tax advantages of running that piece of a real estate as a business. So yes, the value of my real estate will grow from $100,000 to $200,000 over time. And yes, at some point I'll sell that. I will realize that capital gain, yes, at a 20% tax rate. But over the course of that time frame, I've deducted, all of my maintenance, my upkeep, all of the other stuff that goes in that, my interest expense, on the loan that I use to buy the piece of real estate with, et cetera, so forth and so on. I get all that tax advantage to offset the income stream that's coming in. And so the value of owning that in a taxable account far exceeds the benefit of owning it inside of an IRA. So yeah, never ever put real estate inside of an IRA.
Or if you are looking at those private funds or private equity alternative investments where maybe you subscribe like a limited partner in a limited partnership, that limited partnership may own the underlying investments in there might be a real estate holdings. Well, those limited partnerships generate a K1.
Yep.
And which means that's a pass through to you as a limited partner, as an investor. So if there's real estate in there, especially if you're, if those real estate investments within that limited partnership are fairly new, chances are you're going to get some of that depreciation up front.
Yep.
And if you have that investment within your IRA, you lose because that depreciation is passed on to you. You have that in the IRA, you can't take advantage of that.
Yep.
And a lot of folks that we do work with that own real estate, a lot of it's most of the time it's outside of their IRA, and usually, Lance, they're going to hold on to that piece of real estate because at some point their goal is to pass it to their heirs.
Yep.
And so even if the real estate is really appreciated quite nicely, when they pass that to their heirs get a step to fair market value. So they get an increase in that cost basis, and then maybe the heir can sell that real estate in a much more favorable tax position, right? So great point about looking at real estate in IRAs. Those are get a lot of questions around that as well.
That's right.
Yep.
So, all right. Other thing, just to kind of wrap up, I want to talk a little bit about the DOGE dividend. Lots of questions. People just asking about that. It's like, President Trump and Elon Musk talking about distributing back the savings, the tax savings, right, from all these cuts back to Americans, right, returning their taxpayer dollars. Love the idea. I think that's fantastic. Don't do it.
Don't send out checks to everybody.
Will it have the same inflationary impact that we saw the first time? No. And the reason is that we don't have a supply crimp. We didn't shut down the economy, so we don't have the lack of supply. But anything you do, if you send Americans a check, they're going to spend it. And so when they go to spend it, you are going to get a short-term inflationary push for 6, 8, 12 months as that money flows back through the economy. And that's okay. You're certainly going to get an economic bump out of it, but you're also going to pick up inflation, which is going to keep the Fed on hold even longer at that point. Waiting for that money to flow through the economy. A better way to approach that would be to issue a tax credit. I think we talked about this a little bit before, but issue a tax credit because the bottom 50% of taxpayers that pay very little income tax or no income tax, they get a refund, so it helps them, right? They're the ones living close to poverty level anyway. For those that actually pay income tax, you get a deduction, so you don't pay as much tax, right? Which is kind of the same thing. It still gives me more spending money, but it's not an actual check. When you send somebody a check, right? This is why every year in April, we always get a bump to retail sales because everybody gets their tax refunds and they go out and they buy stuff, right? So when you send a check, it's actual cash, right? They'll run out and spend that. They'll say, I'm getting a $5,000 check. I'm gonna go buy a new car, right? If I send you a tax credit or, just you get to deduct it off your taxes, then it's not really cash in the bank. And so people don't run out and spend it. It's just, I just don't pay as much in tax this year, and it kind of gets smoothed out over time. So a better way to do it would be a tax credit, but the idea of sending out checks is certainly something that everybody saw make everybody happy back in 2020. So they're kind of tagging on that as, hey, we'll send people a check, and that'll make everybody really love me, right?
Well, I've had a number of conversations around this with clients over the last week or so when the headlines came out about this potential DOGE dividend, and they would much rather see if money was to be returned, quote unquote, to society out there, they would much rather see the savings, put that surplus over into the Social Security fund, right? Because folks are still concerned about Social Security solvency in 2033, 2034, that time frame. Because right now, and they're, I haven't met a lot of people that really enjoy paying taxes. And I think it's just because when they pay their taxes, they're concerned that their tax money isn't being put to good use. But there is a general consensus out there, at least the folks that I visit with, where they would be comfortable if the wage-based limit that was taxed for Social Security was increased. So in 2025, the first $176,100 that somebody earns is subject to Social Security tax. There are a lot of folks out there, at least that I visit with, where they would be fine actually paying Social Security tax on, more than that, or maybe on, almost everything that they earn, because they want that to go over and to kind of refill the coffer for the Social Security, Medicaid benefit for others. And the general opinion that I'm getting from folks, if $5,000 or so is sent out, but there are a lot of people that I work with, clients that I work with, where their employment is based on, the federal government. And so there's a goal to cut down spending, or what might be seen as frivolous spending in the United States government right now. So if all of these savings are realized and then they just send it out to everybody, but then if I'm a federal employee and my job gets cut because of this, how am I going to feel about that? Right? Not very good.
Right.
So there's a lot of mixed emotions out there around the DOGE dividend right now.
Yeah.
Right?
No, and again, it's look, one thing about President Trump, he is a great marketer, right? I mean, his whole life has been marketing, right? Whether he's selling real estate deals, whatever it is, he is a great promoter, a great marketer. When he was running The Apprentice, it was one of the most highly rated shows. I mean, so he knows what he's doing, right? And his approval rating right now is 53%. There's been a massive surge. Real Clear Politics just came out with a poll today of the approval ratings under the Trump just over the approval ratings of the presidents over the last several years. It's been a huge spike in approval just since President Trump's took office. So, I mean, the things he's doing is certainly hitting home for the majority of Americans. But, and this is just another way to, improve that approval, right? Yeah. So, but again, it just, there's a lot of questions about it. Again, the other thing too is you're going to send out a $5,000 check. Well, the whole purpose of what you're doing is try to reduce the deficit. Now you're going to send out a check, which requires you to issue more debt to do that. So, a lot of people just say, let's just pay down the deficit. I'm more concerned about the deficit.
Yeah.
Let's pare down the deficit, which by the way slows economic growth because you're pulling money out of the economy. But let's pay off the deficit. And if we get everything all straightened out, then let's talk about, for me, I would rather talk about permanent tax cuts, right? Let's cut the tax rate, right? So if you don't need as much money in government, great, tax me less. So instead of a $5,000 one-time check, let's talk about, reducing the tax rate for the average American from 28% to 21%. Something that helps them out long term, because you don't need as much revenue now that you've cleaned up spending in Washington, right? That's great.
Yeah. So we've got a little bit of time left on the show. So another question that I've been getting to is they're visiting with folks where maybe there's a stock position or an investment position in their portfolio that's in a loss position, or it's been in a loss position for a while. What are your thoughts, Lance, around when do you know it's time to cut that thing loose?
It's a tough question, right? Because everything is individual, but again, it's just, when you get to a point to where, and again, we've got a position in our portfolio we're about to cut loose. It's just not performing. It's dragging on the portfolio. It will eventually turn around and we'll buy it back. But sometimes you just have to step aside, let it go through its whatever phase it's going through, and then come back to it later. And you'll buy it back at a higher price, but you'll buy it back in a positive trend rather than a negative trend. Yeah. So, all right, that wraps up the show for today. Be back tomorrow. Got a lot. We'll catch up with what happens in the market today, of course. Be sure to go by the website. Our latest article is out on Substack at Lance Roberts, as well as on the website, realinvestmentadvice.com. Get it either place. We're also now starting to, if you're following us on Substack at Lance Roberts, we're now posting our Before the Bell video on Substack as well, along with all of our articles. So you just kind of, again, we're trying to just put stuff all in the same place, make it easy for you. So just go to Substack at Lance Roberts, get subscribed there. It's absolutely free, as everything is. realinvestmentadvice.com. Have a great day. See you back here tomorrow.